Okay, welcome everybody. We got a special guest tonight. We have Gregory Emmer with us tonight from Equity Max. I've met Gregory through GoRia. I think I might even have met you with CFRI years ago. If you were coming to the CFRI meetings, and I'm sure you were. But anyway, this is the new investor workshop, and I know one of the first questions that new investors have is, where do I get the money? So I've asked Greg to come on tonight to explain to us how we get the money. So here's a guy who's been in the business. It's a family run business, right, Gregory?
Yes, sir. Yes. Yeah. We've been around 30 years, family owned and operated. And I have 2 kids too. So God willing, I can pass the torch on to them.
Okay, so I'm going to turn it over to Gregory, and he's going to explain hard money. He's got a great presentation. I saw it last week, and I think you're going to learn a lot as far as what is involved with hard money. And you even have some pros and cons and pluses and minuses and that kind of thing to cover with y'all.
Definitely. And I'll say this, Carl, if you want to interject at any point and with comments or questions on clarifying things for your particular membership and people that are involved in the association up in Marion County, feel free to let me know.
What we'll do, Gregory, is we'll have everybody type it in the chat box, and then when you get done, then we'll open it up for questions.
Okay, perfect. So welcome everyone. Thank you very much for having me. We are Equity Max. Our company, as Carl was alluding to, we are hard money lenders. And we'll discuss exactly what that is. If I'm looking towards this way a little, it's because that's where I see people, and I'm directing my content and who I'm talking to you. Okay, so we are a family-owned and operated business. We've been around since 1990. We're a licensed mortgage lender in Florida, and that's important because a lot of lenders out there, they may or may not be licensed. And when you can, you want to try and deal with a licensed lender. We specialize in hard money, and I'll be going in the differences between hard money and private money because there is small nuances and differences between the two. One thing that's unique about us in that we're a family-owned operation is that we only lend our own money. Again, another important component of financing is where the money's coming from. And that's something that you'll see makes a big difference in your particular deal, how quickly it can close, how readily accessible the money is to you, and that has an effect. We're very, as Carl alluded to, we're members of various Central Florida area RIAs in Orlando, all the way out to the Gulf Coast, all the way out east to the Daytona area, and even up north in the Jacksonville, Gainesville area, which is obviously close to Ocala in Marion County. So just a couple of things to discuss financing terminology for you new investors out there. If you are new, we can go through them and just kind of get you up to speed on various terms that you're going to come across when you're dealing in real estate investing and financing. So let's go through them. One is an REO. That's basically stands for real estate owned. That's equivalent of a foreclosure. And as an investor, you're going to find a lot of properties that are REOs, as well as short sales. That's the next term. Estate sale, probate sales. I know that Carl and I had spoken about probate listings and probate leads, which is very common among real estate investors. And that's something that obviously, if you're a savvy investor, you'll be on the lookout for those kind of leads. Loan terms. Okay, now this is when we start getting into the finance and lender specific terminology associated with real estate. Okay, so any lender, what you want to ask them or what they're going to tell you is what their LTV is. Okay, LTV stands for loan to value. So that essentially means what they are lending you in relation to either the as-is value, which is a condition an investor is purchasing it in, or loan to after repair value, which is the value of the property after it's fixed up if you buy it in condition where it needs repairs. And you'll see that on the third line there. Loan origination fee. This is also commonly referred to as points. Any lender that offers you financing, generally speaking, is going to charge you some sort of loan origination fee. Okay, it could be 1 point, it could be a half a point, it could be 2 points. And by point, I mean 1% of the loan amount. That's what a point is. So when somebody says, I'll lend you $50,000, but I'm going to be charging you 2 points, that means they're going to be charging you a 2% loan origination fee. 2% of 50,000 is obviously 1,000. So you can bundle that into the cost that you are going to expect to pay with the loan that you're going to take out. Okay. Some terms related to due diligence as part of the loan. Obviously, most of us are probably familiar with what they call an appraisal, which is sending out a person to verify the value of the property. Now, this is more typically done with some larger institutional hard money lenders, but most certainly, if you go into your local community bank or a larger bank like Wells Fargo or Bank of America, and they're going to be giving you a loan, they're most definitely going to want a formal appraisal. Smaller lenders, such as Equity Max and even some private lenders out there, they will do what's called a BPO or a CMA. A BPO stands for broker price opinion. And that's actually what we do at Equity Max. What we do is, instead of an appraisal, which tends to take longer and cost more money, and again, most lenders, and you should want a lender that's about speed, we'll do what's called a BPO, broker price opinion, where we hire a local agent to go out and take a look at the property, pull some comps from the public records, and value the property that way. So, you know, if we were doing a loan in Ocala, for instance, we would employ our local agent that we have in Ocala that we've used before, and we'd have them go out to the property, take some pictures, and value the property based on comparable sales in the area. A CMA, that's a comparative market analysis. That's something that's a little bit less rigorous of a BPO. It usually just entails some data and comps and doesn't involve a full-scale property visit. At least that's my understanding and interpretation, and what I've known to be market standards for what they refer to as a CMA, comparative market analysis. Also, as part of the loan process and any closing in general, if you've ever bought a home or you are actively investing, is a title search, title commitment, and then a municipal lien search and a permit search. Now, these items are very important in determining if there are any issues wrong with the property. So if you ever run into a situation, and there are certain sellers that do not automatically run a municipal lien and permit search, it is imperative that you get one run. This may show that there are code violations, that there are expired or open permits, things that may not show up on a title commitment, because a title commitment is a little bit more broad and generalized. A municipal lien and permit search is definitely more specific, and it will give you additional insight on anything that may be wrong with the property. Hopefully in running the lien and permit search, there is nothing wrong, but it's a great cross check to have in determining, whether you should move forward with the property or not. Okay, and this is done generally after the property is under contract, and the seller and buyer have agreed to terms, and after you've agreed to financing terms with your particular lender. Okay, other terms as it relates to a mortgage and taking out a loan, there's what's called a balloon mortgage. And I think of an analogy when I was in mortgage school, which is a balloon can pop. So think of a balloon mortgage as something that pops, something that can end very quickly. And that's essentially what a balloon mortgage is. A balloon mortgage is something that is a mortgage that ends after a finite amount of time. So if you have a 1-year balloon mortgage, that means that after the 1-year mark, you will be required to pay back that entire loan in full. Okay. Some lenders, not all, but it's interesting. We've been in this business long enough, our company, and I remember when a lot of lenders charged a prepayment penalty. That meant that, let's say you had a 1-year balloon mortgage. Okay, that means that let's say you borrowed $50,000, which we said previously. At the 1-year mark, you would be required to pay that $50,000 back in full. And sometimes if you wanted to pay it off, let's say at the 6-month mark instead of the 12-month mark, there would be a prepayment penalty for paying it off early. Nowadays, though, the market has definitely shifted to a 0 or no prepayment penalty climate. So certainly if you are borrowing money and you are being charged a prepayment penalty, there are other options out there, several options, which usually do not entail one. One option, if you don't want to go with hard money, and we'll get into those specifics, is going to a regular bank. Not saying that you need to or will. This slide is really just for purposes of showing the contrast of what you get with, walking into your normal community bank, let's say, or credit union versus going with an equity max or a hard money or private money lender. You can get potentially a very high loan to value, 85%, certainly a lower rate, maybe, sub 5%, sub 6%, only 1% for a loan origination fee. Remember, 1% is equal to 1 point. But here's where, the going gets tough. They are going to require every document under the sun to qualify you. We're talking about bank statements, tax returns. They're going to have minimum credit requirements. They may even require experience in the real estate investment space. You're going to have a formal application. You may need to pay an application fee for it. They're definitely going to want an appraisal. That can run $500. They're definitely going to want a survey. That could run $300-400. But look at that next line, 30 to 45 day closing timeline. That is the real kicker here, if you will, because real estate investors that need financing, they are competing with cash buyers, ones that can close without all these requirements, and they can close in 2 weeks. So you, as a real estate investor, if you need financing, have to position yourself to be able to compete against that. And if you go into your bank, while they're charging you a very low interest rate and minimal fees, if they take 30 to 45 days to close, the seller is not going to want to wait for that, especially when they have a cash offer that can close without any of the same contingencies in a faster time. So that's why it's important to always weigh your financing against, well, what happens if I don't get the property at all? Because what's a low rate, minimal fees if you can't close on the deal? And sometimes going with a hard money lender may entail it being a few $1,000s more. But if you intend on making $20,000 or $30,000 profit, the difference between not making that, or rather, difference between $30,000 and spending a little more in a hard money loan is not getting the property at all if you went with your regular bank and making 0. So that's the key difference here in understanding why hard money is effective. What is the true opportunity cost? It's not a couple $1,000s extra. It's not getting the property at all. And with properties being as scarce as they are, as Carl and I were discussing prior to the meeting, you really want to align yourself with financing options that will make sure that you close, because that's the most important part at the end of the day. Again, if you want to go with your bank, they're usually going to want properties with minimal rehab, and especially if you're a buy and hold investor, they're going to want the property stabilized and occupied, certainly for a few months before you even go to the bank and go for financing. If you are in a position, and it's definitely a good position if you can get bank financing and successfully close on your property, great. But if not, you have options such as us, hard money and or private money. There is some small differences, as I alluded to earlier, that I'd be discussing, and here they are. Generally speaking, hard money is over a larger geographic scope. We, Equity Max, lend in 46 states. While we primarily focus on Florida, we work around the country. We generally just lend the money. Okay, we do not take on equity or joint venture participations. And certainly being larger in scale and being in more places, we have the ability to do more. Equity Max only lends our own money, but you'll find other competitors out there that borrow money and do equally as much as us, if not more, just because of the sheer amount of cash that they have. In contrast, private money, when I think of private money, I think of an investor, a private investor that has, some spare cash, doesn't do 10, 20, 30 deals a month. They do a deal here, a deal there, maybe one or two a month. They're really focused on their local market as their core market. Sometimes instead of just giving you the money and getting interest, which is what we prefer, they're willing to become a passive investor, meaning maybe they'll take a slice of the profits after you sell it, or maybe they'll take some sort of equity participation in your business in general if you're doing more than one property. At the end of the day, though, private money, you are limited in scope, reach, funds of what you have available from them because they're generally just smaller. So, I always say that it's important to have both at your disposal because you never know when you're going to need one versus the other. So in terms of the hard money / private money scenarios that our investors encounter, it's definitely something that's meant to be short term because the interest rates are in the double digits, 10, 11, 12%. And that kind of cost is going to bury a borrower if it's held for longer than a year. We've done the math. Savvy investors can do the math. It's meant to be short term, 3 to 6 months maybe. Not generally needing to have a whole lot of documentation to qualify. For instance, Equity Max just requires a credit report. We don't require any bank statements, tax returns. What you'll find is that the more documents a lender requires, not only does it take longer, but they'll sometimes offer you a cheaper rate, but that comes at a cost and being able to potentially not close on your property in time. Obviously, hard money is typical for fix and flip properties, cash out refinance properties if a borrower owns their property free and clear. And also look at that middle one, buy and hold properties. But you may be thinking to yourself, well, hard money is meant to be short term, is it not? So let's talk then and go back to that slide that we were speaking about before, which is hard money versus a bank loan. Okay, and that is, let's say you have a property that you intend to keep 10 years as a buy and hold, but you need a quick closing and it's not occupied, and there's no way that even if you went to your bank, they would finance you. So what you do is you utilize hard money to close, you fix up the property, you put tenants in there, show stable leases of 3 to 6 months, and then you go to your bank and you refinance when you have all your ducks in a row. Okay, so that's where hard money or private money is purposeful, even on a long-term or presumed long-term property like a buy and hold. Okay, and most importantly, as we alluded to, and I'll probably allude to again, you definitely should expect a quick closing with a hard money loan. We received a deal today, for instance, last night / this morning. It's in Orlando, and they're closing Friday. So hard money, or at least the hard money lender, private money lender that you want, you should expect them to be able to close that quickly, the same week, if possible. So the process, what do I mean by that? How do we start and go from beginning to end when you're looking to obtain financing? This is really going to give you a step-by-step look at how one should go about securing a loan from their financing sources. Okay, so once you've zeroed in on the lender, and hopefully you will have done your due diligence on what their terms are, what their loan to values are, etc. Once you have your property, you want to call your lender, communicate with them, email them, and give them the pertinent details, the address, the loan amount you're seeking, what you think you could sell it for, because a lender's going to have their idea, but it's always good to go to your lender and explain to them your point of view. It definitely shows that you know what you're talking about, and it shows that you have information at your disposal to make an informed decision, and it puts you in a light that is looked upon positively by your lender. I'd say when a borrower can tell me an outline over the phone of what they intend on doing with the property, I think to myself, this individual has their act together, and that increases the level of comfort that I have in giving them the loan, giving them some money. So once that happens, you obviously, if you're not already qualified with them, you want to qualify with them. You want to know how you qualify with them, what they require, and provide them all necessary documentation that they need. Obviously, if it's a purchase, they're going to want the contract. Most will want a credit report. If it's a refinance, some may want to see when you bought the property, so they may ask for the original settlement statement. It varies, but generally make sure you're organized and you have all your documentation ready to go. After you've discussed loan terms and provided them the necessary documentation, they're going to want some sort of valuation, whether it's a formal appraisal, a BPO, or a CMA, and we already discussed that previously, what those are. So after that comes back, hopefully the valuation was confirmed, what you're paying for it versus what the lender's representation saw it to be through that BPO or appraisal or whatever. After that, they're going to issue you some loan disclosures. These should be fairly boilerplate and not extensive. Typically, just to give you a reference point, our loan disclosures, they basically outline the cost of the loan. We outline that obviously this loan is for investment purposes. You don't intend on living in the home, and once you sell it, the proceeds are going to go towards your building your business and not for personal use. Okay. After that, we will then coordinate with the title company to run that lien search, that municipal lien and permit search on that title commitment. Okay, generally speaking, that will take anywhere from 3, maybe 5 days to come back, and your lender should be able to close within short order after they get that. If they're not, then something is amiss, and they may be stalling. They may have run out of money. I've seen it all. So that's why it's important to vet the process, if you will, from beginning to end, and make sure that you're dealing with someone that's for real, that's legitimate, that will close and knows what they're doing. Because the last thing you want is to be at the closing table or the day before closing and you can't find your lender. And if I had $1 for every time that's happened to us over 30 years, we'd have a lot of money. For what it's worth, I've been doing this 15 years, my father 30, and we've seen it a lot. So it does happen with some frequency. Your lender is going to have questions for you. That is for sure. And we've already discussed ways that, you can be informed and get your point across in an informational and smart way to your lender. But at the same time, you should ask them certain questions. And again, that adds to the impression that you give them as it relates to the loan that you're seeking. Ask them how you qualify. How do you base your loan amount? Some want some, as they call, skin in the game, meaning whatever you're paying for, they want you to pay a % of that purchase price down. Others, on the other hand, will lend against the future value of it. And if that exceeds the purchase price, they will give you money beyond what you're paying for it. Now, when the market was rising prior to COVID, we saw this happening with more frequency. I will say, though, that the market for these highly leveraged loan amounts and high loan to values, where borrowers are leaving with money at the closing table as opposed to bringing money at the closing table, it's becoming less frequent and happening less often. So I suppose my point is, when you are getting money from your lender, you are anticipated and expected to bring some yourself. Also ask your lender how long their loan is for. Is it a long-term product, or is it something where you're going to need to pay it off in 6 months, a year, 2 years? And as we talked about previously, is there a prepayment penalty? Not a lot of lenders out there charge this anymore, so try and find one that doesn't. Also, what do they charge for interest? What are the points? What's that loan origination fee? Are there any other charges? When we get a call for a loan, I can't stress this enough. The first thing they ask, what's your loan to value? What's your interest rate? And what are your points? And I cannot say strongly enough that the costs of a loan go beyond that. If someone charges 2% as a loan origination fee and no other fees, and someone else charges 1%, but they charge $400 for an appraisal. Their attorney charges $500 to prepare the mortgage docs. They require a survey, et cetera. That can add up, and your 1-point loan can be more expensive than your 2-point loan. So in its simplest form, you want to ask your lender, what are all the fees? All the fees. And every lender can name them in a variety of ways. I've seen it all. Underwriting fee, processing fee, administrative fee, mother-in-law fee. I haven't seen that one, but they'll give any name for a fee so long as it gets them money. And just be careful and ask what all the costs are, as opposed to what's the interest rate, what are the points. Okay. And last but not least, important to note how quickly your lender can close. And you want to ask them that because obviously the real estate investment game is about speed, and you want to make sure that whatever that date is for closing on the contract, you're going to be able to close on or before that date. And the last thing the seller wants to do is sign an extension because they may think that you're going to flake out. So don't be that borrower. Find a lender that's reliable. Ask for their proof of funds. The seller is going to ask you for your proof of funds. When we give a pre-qualification and proof of funds letter to our borrowers, it includes our bank statement. That's as legitimate it gets to, you seeing from your lender that they have the funds to close your deal. So I wouldn't be too shy to ask for that if you end up going to pre-qualify with a lender. So you have some questions for a lender. They're also going to ask you beyond the pre-qualification and the general information on the property. They're going to want to know, is there equity in it? Are you buying it at a discount because it needs a little bit of work? Is it a buy and hold property that you're buying very close to market value because it doesn't need a lot of work and it's already stabilized? They're going to ask what kind of repairs it needs. Are these extensive repairs that may require permits, or are they cosmetic repairs? Lipstick and rouge, as they call it, paint, carpet, that kind of thing. They also want to know, as we mentioned before, skin in the game. Is the borrower bringing any money at closing? And that's important to at least have the answer to. They may want to know your credit worthiness, how you pay your bills, and how you've paid your bills in the past, both maybe on loans, on a mortgage for your primary residence, on a car, or even with another hard money lender, they may want a reference letter. What is the exit strategy as well? They want to know what your plan is, and you don't want to this is just from personal experience, but never overstate or oversell the loan. I would say try and be as realistic as possible. If you have a property that's needs 40 grand in rehab and you say, oh, I'll be done in a month, it's probably not going to happen. And then you look potentially or come across as someone that may not have their job in order. And, I'm not saying it become problematic, but you want to sound legitimate and make sure that you know what you're talking about. Carpet and paint, yeah, that could get done in a week, maybe a week and a half. But if you need to put a roof on, or you need permits just to go through plans processing, could take a week or two. And you want to make sure that you build that in and you're able to articulate that to your lender when they ask what exactly is going on with the project. I just mentioned before, getting a proof of funds letter. That's very important in your offer process. You know, it lends itself to showing the seller how you're getting your money. And they want to see that because an offer without a proof of funds letter is, you know, a piece of paper with an IOU, basically. You want to submit your offer with a pre-qualification letter to give it legitimacy. You want it to be from a reputable lender. You don't want it to be a form letter, no boilerplate language. You want it to be specific, something that has your personal name or your LLC or your IRA, because you can buy properties in a self-directed IRA or in a land trust. You know, you want it made out to that specific entity that's going to be buying property. Are you using a local independent lender? Are you using a national lender? Regardless, you want to see if they can give you their bank statement. That again shows you that they have the money to fund your deal, and it shows the seller that the funds that you're getting are coming from a reliable source. And last but not least, those things all in all will lend credibility to your transaction in the seller's eyes and the listing agent's eyes that you are for real and that you are going to close by the closing date. So we're going to go through a couple property scenarios right now on, you know, whether it makes sense to take out a hard money loan. Okay, so let's go through those. Here is a fix and flip situation, fairly straightforward. We're going to go through the situation where if you were to take out a loan and if you were just to buy it cash. Okay, so the items that you'll see in red here are costs associated with taking out a loan. Okay. And let's take a look at, you know, how much money you'd make and the rate of return that you would based on purchasing it cash or a loan. So let's say you buy it for 100,000. You know, it needs 25,000 in repairs, as you can see by that third line item. You have to pay about 1,600 in points. That's 2%. There's some closing costs involved, and ultimately holding it for 6 months, you have to pay almost $5,000. Okay, those coupled with the closing costs, with a loan, you're going to have to pay over $41,000. Without a loan, you're only paying $33,000. Well, taking out a loan is more expensive, is it not? Yes. On the surface it is, but at the end of the day, the rate of return is a lot greater when you use leverage and you're taking out this loan because you're not using as much of your money. And you can maybe use that additional money on another property. Cash profit, if you look at, you see the $175,000 sale minus the original $100,000 purchase price and the total cost without the loan. If you see that, $33,500. That cash ROR, that third line item in the bottom right, is 31%. You take that 41,500 profit and divide it by the total cost, which is 100,000 plus 33.5. Okay. Now the loan profit from an aggregate, you know, absolute level is going to be less. You're only making $33,600. Why? Because if you see those items in red, you know, those are costs associated with taking out a loan. However, if you see the profit that you made divided by the actual cash that you use, and what was that cash? That cash was the total cost with the loan, $41,400, plus the 20% down payment. If you look in the top right, you can see the loan amount was $80,000. So you originally had to bring $20,000 to closing. $41,400, which is your total cost with the loan, plus that $20,000 down payment, you're looking at $61,400. If I had like a little, you know, like a pointer, I'd show you that, but it's that number in the bottom right, all the way bottom right. So if you take your profit that you made while still keeping the loan, $33,600, and you divided that by 61,400, your rate of return is 55%. That is greater than your cash rate of return, which was only 31%. The moral of the story is taking out the loan made sense. Your rate of return and your profit percentage was higher in this case than it would have if you just bought it with cash. Okay? If anyone has questions, they can let me know. Here is a second example with a buy and hold property. Let's say you're buying this property a little under market, $80,000 purchase, $130,000 ARV, $64,000 loan amount. So you have to bring 20% down. Let's do the rents at $1,500. You take out a vacancy allowance at 20%. Anyone that tells me they want to take out less of a vacancy allowance, I say, look at that right number there. 1 month is equal to 8.3%. Okay, so if you're renovating this and it takes 4 to 6 weeks, and then it takes another 2 weeks, to rent it, that's almost 17% right there. And that doesn't include any further vacancies, any further tenant issues, maybe with them not paying, et cetera. So, always err on the side of caution. And worst case scenario is if you don't have that vacancy, you just end up making more money. We take out then, look at that third line item, property taxes, $1,700, fire insurance of $600. We don't suggest or require on our end wind insurance or flood insurance, especially potentially in the central part of the state where, a lot of the cities in Marion County are. You can also take out a maintenance allowance of about $1,000 over the course of the year. And appliance breaks, you have to replace some flooring or something. Then obviously the most important part is the profit. You have to make some money over the course of the year for this to be profitable. So after you take out all those line items, the vacancy, taxes, insurance, maintenance, profit from the rents, that last line item left for mortgage payment, that's what Equity Max or your lender has to collect. Okay. Now, if you take that and divide that by, let's say, a 12% interest rate that they charge, the maximum loan amount that they could lend the borrower to make sure that the borrower is net cash flow positive is $65,000. Okay, so that's the max they could lend, $65,000. Let's look at that top right figure, loan amount of $64,000. The moral here is that the rents can sustain a hard money loan. Okay. So sometimes, not that you'd want to keep a 12% rate with a buy and hold property, but if you're buying it enough under market and you do want to be a buy and hold investor and you don't want to flip it, there are still opportunities to utilize a hard money loan long term. And, I'm going to go back here and just allude to something because it's not happening right now, but this is exactly what happened in 2008 to about 2012. This exact scenario where banks were not lending, you were able to buy properties cheap, $80,000 that you presume would ultimately rise in value, and you couldn't get that 4%, 5% rate from your bank because they weren't lending. So you had to go with a hard money lender, and this was a situation where rents weren't completely plummeting, and you were still able to get a decent, return on the property that you bought. And even in a case like this, you could sustain a hard money loan based on rents given this purchase price. So, if the market ever takes a dip and banks aren't lending or whatever, just know that under the right circumstances, if you're a buy and hold investor, it can still pay to take out a hard or private money loan. Here's just a quick scenario where it doesn't work. If we do the same math, you take a property, 120,000, it has a sizable ARV, and the loan amount's 80%. The problem here, and I'll summarize it quicker, is that the rents on a $120,000 property are only marginally higher than maybe a slightly less, a sizably more, a sizably cheaper property like that one that was 80,000. So, just because a property is more expensive does not mean that, the rents are going to be higher. If something was, this is, I guess, what was this, 30% more. The rents were not 30% higher in this case versus the other one, 80,000 at 1,500 and then 1,800 at 120,000. So, just make sure that you're doing your math and, you have a strategy if you do take out a hard money loan on a buy and hold property that you're going to be able to refinance quickly because you're not able to sustain net cash flow positive with a hard money loan. So here's something that's also come up recently. I say not recently, but post Great Recession, and that is rehab money. Always take a step back and wonder if taking the rehab money from your lender is worth it. They're going to want bank statement verification, making sure you have those rehab funds in there already. Are they going to control the draw schedule, or are you going to be able to control it? When is interest charged? Is it charged on the full balance before you've even gotten a disbursement from them, or is it charged only on money that you've taken out? How much do they charge for an inspection fee? I've seen one lender charge as high as $300 per inspection fee. And if you don't pass the inspection, they got to come back for $300 more. How long do they take to wire the funds once they do approve the inspection? Because this all can make the difference in the speed of your project. Instead, if you don't want to go that route, you could obtain funding from a private partner, a JV partner that could give you that rehab money, and couple with funds from a private lender that don't entail the rehab money. You can always raise capital from friends and family, or you could just find a rehab-friendly lender that doesn't have all the red tape of inspection fees, draw schedules, etc., and will give you the money more on your own terms. So we're finishing up here, and life after hard money, basically some tips on helping you sell or refinance your property. From the beginning, you want to know how long it's going to take you to either rent the property and refinance or fix it up and sell it. Just like I'm doing here, and the rest of you watching this, whether it's now or at some point online, network. It's going to open up a lot of relationships, brokers, listing agents, selling agents, originators, financing options for your end users, etc. And you always want as many of those at your disposal as possible. I don't entirely recommend going on Zillow and Redfin and all those websites for your valuation on the properties that you're looking at. So try and find more reliable ones, and sometimes this entails paying for it. But I assure you they're going to be more concise and more accurate than what you can find for free online. Some things a lender won't tell you, but things that do come up and you want to ask them. What is their financial capacity? If you think you're going to be a borrower that has an appetite for 10 loans over the course of the year, and they maybe only have the money for 5, you have to temper your expectations and seek out financing from multiple sources. Insurance requirements. Do they require wind insurance, flood insurance in a market that otherwise may not be subject to windstorm? Or, if you're here in Florida, obviously during hurricane season, if you're doing a loan and you're buying a property in November and you're going to flip it in May at the latest, there's no real point in wind insurance, and you want to find a lender that may not require it. We spoke about this earlier, but beyond the rate, the points, what are the other fees associated with the loan? It just does not come down to the rate and only the rate. And last but not least, does your lender agree with everything that you're saying? You want to be on the same wavelength with him or her, and that will lead to a more seamless transaction and building a relationship with the person that's giving you money. So that was the presentation. I thank Carl and thank all of you for listening, watching, whenever that may be. Our phone number, and I'll give you my cell, is right there, 954-663-5410. My email is GregoryEmmer@equitymax.com. And I gave my personal information on there because this is a 24/7, 365 business. And back to being on the same wavelength with your lender, you want someone that can talk at 6 o'clock at night, maybe able to run a deal past them after hours, because that's going to give you the highest rate of success when you're not working with a 9-to-5er, because that may be a difference maker between getting a deal and losing a deal. So thank you, Carl, for having me. Thank you to everyone for listening. And if you have any questions, I'm available now or after the meeting.
Okay, I just got, looks like I'm the only one who's typing anything in the chat box here. I got several things. First off, you had mentioned both the title search and the lien search, and that's pretty much standard today. That's something that kicked in about 2 or 3 years ago with the lien search. The permit searches, that's also being done by the title company a lot of times, but what I'm finding or hearing is that the permit searches are really required by the insurance companies or anything else, because the insurance companies won't provide insurance, and then the mortgage companies will not provide the mortgage if the insurance company won't insure it. So and Peggy and I just got caught on one of those when the permit search, and I'm not going to go into all the details, but it cost me $3,000 to prove to the insurance company that there was not a sinkhole on the property. Here's a question. If the borrower is a realtor, will you accept their CMA, or do you need to get another realtor to provide that?
You know, we try and keep everything independent, but what we will do is we are more than happy to take the information from that realtor and have our representation verify it. So that's certainly something within the realm of what we currently do and have done. But you know, at the end of the day, it's in addition to the value, we want our own set of eyes on the property. If the borrower is a realtor or anyone and they say, hey, everything's fine, you know, oh, there's a couple roof leaks, and then, you know, we otherwise go to the property and see there's, you know, a hole in the ceiling, or, you know, we see brown spots in the ceiling in more than a few places, that tells us that there's more significant problems. And again, all of what we do, and even certainly other lenders out there, is based on what we've learned from the past. You know, prior to 2008, we really didn't look at the properties. You know, we got pictures where we could, and we just kind of took their word for it, and we were riding the wave like everyone else. You know, what's the point in going to the property if we know property value is just going to keep on going up? But obviously that didn't last forever, and now we're just a little bit more careful, and we want to make sure that we know what we're lending on. So if we ever take it back, we know what potentially we may have to fix or mitigate.
Okay, you had mentioned fees. I can tell you from experience, there was a company in New York State that was offering some very attractive rehab loans. And so Peggy and I took advantage of that. The interest rate was good, the points were good. But when we got to the closing, there was about 15 different fees on there that I said, oh my God. I mean, I could not believe what.
And they did not disclose this prior. I mean, I would have flipped out on them. I find that to be not predatory, but not transparent.
Yeah, they even had courier fees. So apparently, you know, there was somebody on, you know, across town or whatever, and so the lawyers had drawn up a document and sent it over to the lender, and we paid a courier fee to carry it over there. So it was nuts.
It happens. It happens.
Yeah,
and that's why you want to ask these. And you know, if there are any quote unquote junk fees, regardless of what they are, and they exist. I mean, we as a lender, we charge an underwriting fee. Call it whatever you want. And the point is, though, is that we are fully upfront, and we disclose that before the borrower gives us a dime. You know, we disclose all that before doing the BPO, so that the borrower knows what the costs of the loan are. You know, I think it's horrible for anyone if they see all these fees that they didn't agree to at closing, because then, you know, they're stuck with their tail between their legs and they have nothing else to do.
Yeah, what happened in this case, they originally agreed to let the local title company handle the closing. And then the day before closing, they said, oh, no, 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 we're going to do the closing back here in New York. And that's when all the fees got slapped on. It was, and they were double what I pay here in Florida for the standard fees.
I'm sorry.
All right, here's another question. If a new investor has no experience, should they JV with an experienced investor to make the hard money loan easier to obtain?
That depends. You know, it depends on the lender. Sometimes you can't find a JV partner, and sometimes you're going to need to find a lender that's open to dealing with newbie investors. We, Equity Max, love new investors. If you have the credentials of someone that has paid their bills and you have decent credit and the deal's a good deal, we're going to treat you like someone that is going to be a good borrower, and that's going to get you, you know, premium, optimal terms. You know, but at the same time, if you don't have that option of a lender that may not be new investor friendly, you may need to find a JV partner that will go in with you, that may co-sign on the loan, at least to get your feet wet and get you the loan that you need to close. So it just depends. Certainly, if you know absolutely nothing, having a JV partner will just help you throughout the process. But you know, there are options out there to get financing without it. So if you're concerned that you won't be able to get financing without experience, it's just not true. But at the same time, a JV partner can mentor you and help you through your first deal or two. And you should want that if you have access to it. Just make sure they don't take too much of the profit, okay?
Okay. All right. Next question. And this one is having to do with our present day situation. Are you giving any buy and hold loans during the COVID with the eviction and foreclosure moratorium going on?
Well, we don't typically, you know, our loan product is meant to be short term because we don't offer the 4%, 5%, 6% loans. I mean, our rates start at 10%. That's expensive. But we're business as usual at Equity Max, and most other lenders are trying to keep some semblance of normalcy. You know, I'd say with, you know, the real estate market back in 2008 was a direct hit. It's like, you know, it's like down here in South Florida. I don't know if anyone remembers it, but Hurricane Andrew, I mean, that was a direct hit on South Florida. And back in 2008, you know, the economy and the collapse was a direct hit on the mortgage and real estate market. Now we're like one of the outer lying cities away from the eye of the storm. So, you know, there will be some collateral damage, but I don't think it's going to affect us to the level it was in 2008. And I think because of that, you know, the real estate market will remain robust, and the same types of loans that you were getting pre-COVID, you will be able to get now from us or anyone out there.
Okay, Elizabeth had a question. She says, in the process, what does GFE stand for?
Good faith estimate. Good faith estimate. That's just a generic, usually that was boilerplate terminology of paperwork that you get from your lender with the disclosures. But good faith estimate is what it stands for. And you know, whether it's called that or not, you know, you're going to get an estimate of closing costs that you can expect to pay along with all the disclosures, usually after the appraisal, BPO, CMA, whatever it is, comes back.
Okay, one comment I'd like to make is, and I guess I learned this when we were first starting in the business, and we thought we had a deal, and we went to a hard money lender here locally in Orlando, and they turned us down. And of course that upset me quite a bit. I said, you know, because I thought I had a great deal in my
and look what happened.
And but what I learned from that though is that sometimes if you go to a hard money lender and you got a set of eyes looking at that deal that are being very objective about it, The good thing is they might keep you out of a bad deal. So that's something to think about too when you're dealing with a hard money
Yeah,
lender.
I mean, you know, yes and no. Certainly yes. I will say this, and it's not something that it's necessarily a good thing from a lender perspective, but you know, we're looking at it from a financing perspective. We are not looking at it from hey, what happens if we take it back and we foreclose on the borrower and we fix it up and then we sell it? You know, whenever an investor says, oh, well, if I don't pay, you can just take the property back. But, you know, that's not what we're built for. That's not what lenders are built for. Lenders are built to look at a property, underwrite it as if they're going to get paid monthly, and underwrite the borrower to make sure that the borrower can pay. When the market collapsed in 2008, we essentially morphed from a lender to a property manager because we were taking so many properties back. And I gotta say, we are a lot more comfortable in the lender shoes than we are in the landlord and property management shoes. So, you know, at the same time, yes, lenders, I'd say, are more conservative than investors. So, you know, take it with a grain of salt, but generally, yes, a lender is not going to want to put you in a bad deal as an investor, but sometimes they can be almost too conservative. And, you know, that's why you have a variety of different people at your disposal to run deals by. You know, it could be that JV partner and mentor. It could be, you know, some of your members, Carl, that see the kind of experience that you've had. And, you know, given that you run this RIA, may come to you for advice. You know, so just use what you have at your disposal to try and make, you know, the best decision you can. And that entails getting opinions from a lot of people, potentially.
Okay, does anybody have any other questions? I don't see anything else in the chat box. Liv says, after closing, when is the first payment due? In 1 month, or can payments be made after a certain amount
It depends. Some lenders will, Elizabeth, I hope you will be a future borrower of ours. We'd love the opportunity. But it just depends. You know, sometimes this goes back to the hard money versus private dynamic. Sometimes private money lenders will, you know, say, hey, you know, pay me all deferred interest at the end. You know, because it may not be their primary source of revenue. You know, they may be a doctor or a dentist and they're just doing this on the side. Whereas a hard money lender like us, Equity Max, we're going to want to get paid monthly starting from the beginning. So let's say you close the deal in September, your first payment, because interest is paid in arrears in the state of Florida, would not be due till November. Okay. If you close at the beginning of October, at the same time, your first payment would then not be due till December. So, you know, a good way of thinking about it is the day you close, it's not that month, it's not the following month, it's the month after at the beginning generally.